Fun fact, did you know that most retirees believe healthcare will be their #1 drain on their retirement nest egg? But here's the truth, it's not. Surveys show that more than 6 in 10 people between the ages of 60 and 70 say that healthcare costs are their #1 worry in their retirement. That number is higher than the fear of running out of money or even the fear of inflation. But when you look at the numbers over a full 25-year retirement, it's not your doctor or your mortgage that drains most of your cash. It's the IRS. Uncle Sam takes a bigger bite than both of those two things combined. So the real question is this: can we or how do we flip the script? Hi, my name is Patrick Hammond. I am a senior wealth manager, a certified financial planning professional, and co-founder of Guardian Financial Services in Salem, New Hampshire. My mission today is simple: help you turn silent tax leaks into lifetime savings. I'm going to walk you through 3 tax pitfalls that I see retirees sometimes underestimate and 3 strategies that you can use to fight back. Because if you know the pitfalls and you plan around them, you can keep more money where it belongs, in your pocket and not in Uncle Sam. So pitfall #1 is RMD shock. After or at age 73, required minimum distributions, RMDs, start to kick in whether you need the money or not. Picture this: $1 million in a traditional IRA. Your first year RMD is about $36,500. Add Social Security, maybe a pension, some rental income potentially, and suddenly you've shoved yourself from the 12% tax bracket into the 24% bracket or higher in a single year. That's like getting a raise that you never asked for, except some of that bonus or a lot of that bonus could be going back to Washington and not necessarily your pocket. Now, RMDs are not the end of the world, but ignoring them can create an ugly tax surprise. The smart move is knowing how they'll hit you and adjusting your plan before, keyword before, that day comes. Pitfall #2 is the Social Security and IRMA trap. Up to 85% of your Social Security benefits can be taxable. For married couples, if your provisional income is above $32,000, half of your Social Security is taxable. If you cross $44,000, up to 85% gets taxed. But that's not all. Hit the wrong income threshold and Medicare slaps you with IRMA surcharges. That's potentially hundreds of extra dollars per month gone out the window. And here's the kicker: you won't even see it coming more often than not, because Medicare uses a 2-year look back on the surcharges that show up 2 years later, long after the damage is already done. So pitfall #3 is tax bracket creep. This one is sneaky, and I already touched on it a little bit. The order of your withdrawals matter. If you spend taxable brokerage dollars first and then dip into traditional IRAs later, you're stacking ordinary income on top of capital gains and dividend. Over time, that stacking effect quietly pushes you into higher brackets and inflates the tax rate on your investments. Even if your first year of retirement looks modest in terms of taxes, the compounding effect can balloon your lifetime tax bill by 6 figures, maybe more, maybe less. And by the time you notice, it's usually too late to undo. So what do we do here, guys? Well, I said I'd give you 3 strategies, and #1 is precision Roth conversions. Think of your tax bracket like a glass of water. The bottom or the halfway up your glass is already filled with things like your income from pensions, Social Securities, or maybe some of that rental income. Now, the strategy is pour just enough water, i.e. your traditional IRA, to fill up the top of the glass, but don't spill over the glass or spill over into a higher tax bracket. Then convert that traditional IRA money into a Roth, pay taxes on the conversion today, and continue to let that asset grow tax-free forever. This shrinks your future RMDs and gives your heirs a clean tax-free asset and lowers lifetime taxes. For many retirees, the golden window is between the day you stop working and the year you turn 73 for Roth conversion strategy. Roth conversions are often most powerful during those earlier years. Strategy number 2 is tax smart withdrawals or tax smart withdrawal sequencing. In your early years, before you start taking Social Security, your income is typically lower. Maybe you just have some dividends, maybe you're doing some part-time work. That leaves room to sell long-term winners in your brokerage accounts and pay potentially 0% on federal tax on those capital gains if your income is about $96,700 if you're a couple in 2025. And that'll allow you to reset your basis higher, reinvest, and avoid bigger tax hits later down the line. In your middle years, after you start taking Social Securities, but before RMDs, benefits and maybe part-time work are filling the lower bracket. Each year, pull just enough from your traditional IRAs to top off the 12 or 22% bracket to cover the extra spending with your brokerage account sales. That trims future RMDs, that helps you dodge the IRMA cliffs. And then in the later years, when you start taking RMDs, you've already downsized your IRA and you can lean on those Roth assets and cash. Roth withdrawals don't raise your adjusted gross income, so you can avoid IRMA surcharges and higher capital gain tax brackets. That means steadier after-tax income and fewer headaches for you. Now, last but not least, the final strategy here is location and lifestyle arbitrage. This one might be different. Finally, where you live matters, in my opinion, at the end of the day. There are 8 states, Florida, Texas, Tennessee, Nevada, Washington, South Dakota, Wyoming, and Alaska that have no state income tax. Others, like Pennsylvania and Mississippi, exclude retirement income such as Social Security or pensions from their tax rate. Even if you keep property in a higher tax state, changing your legal domicile to a no or low tax state can erase 3 to 13% of your income tax off the final bill. That's huge in my opinion. Of course, you need to follow the rules, update your driver's license, your voter registration, pay attention to day count tests, things of that nature, and review every couple of years law shifts more often in the state in which you're taking your income at. So guys, just to kind of recap here, let's bring it all together. Today, you learned the 3 silent tax pitfalls that I sometimes see: RMD shocks, tax benefit traps, and bracket creep. And you've also learned 3 ways to fight back: precision Roth conversions, tax smart withdrawal sequencing, and even using geography to your advantage. Now, I want to thank you guys so much for watching today. I hope this helps you turn your silent tax leaks into real lifetime savings. For educational purposes only, please consult with a qualified advisor or tax professional for professional guidance. My name is Patrick Hammond again, and I am the financial advisor for people who don't love financial advisors. Thanks for watching the video.